So, Assalamualaikum warahmatullahi wabarakatuh. My name is SAFUAN bin BAHZIN. So, today I'm gonna explain about the managing income tax. Under the managing income tax, I will explain about the objective of tax management and tax accounting methods. So, we move to the definitions, which is definition of tax. Tax is a permanent instrument for collecting revenue. It is a major source revenue in the developed world and has been appearing as an important source of revenue in the developing world as well. It has been an instrument of social and economic policy for the government, raising revenues, boosting up the company, redistribution of wealth, minimizing unemployment rate are the main objective of tax. So that is the definition of tax. Now we move to the objective of tax management. Objective of tax management is to comply with the provisions of income tax law and allied rule, which is it must follow the rules and tax law. Next is deals with the filing of return in time, getting the account audited, deducting tax at source, which is mean that is tax return. The tax return is authority that report income, expenses and other tax information. For the tax management relates to the past, present and future. For the past, it includes assessment proceeding, appeal to the commissions, revisions of return. For the present, it must have been proper maintenance of the book of accounts, getting accounts audited periodically, preserving data and voucher that support the transaction, timely filing of income tax return. For the future, it must be taking corrective actions and planning investment to save the tax. Tax management help avoiding payment of interest, penalty, prosecution. So we move to the tax accounting method. In tax accounting method, there is two methods, which is cash method and accrual method. These are also known as a cash basis and accrual basis, or cash accounting and accrual accounting. It seems the definition is same. So for the cash method, it means that the method of recording transaction for revenue and expenses only when the corresponding cash is received, only when a customer pays for a bill, product or service, and you record the payable only when it is paid by the company. Cash basis accounting is allowed for tax purpose only for smaller entities, and it is not acceptable under generally accepted accounting principle or international financial reporting standard. So the advantage for the cash method is it is simplicity. This is because it is easy to track money as it moves in and out of bank account. So you can figure out the exact amount of cash your company has at any specific moment. Next advantage is delay tax on growing, which is mean income are not subjected to taxation until the money is actually received. For the disadvantage of cash method, the first advantage is poor measures of income. So they need to dig into non-accounting data to understand activities occurred during the month. The other disadvantage is potentially difficult to switch over. This is for the cash method. it is difficult to switch to the accrual method when the company become bigger. So it have a rules to change to the accrual method. Next, we move to the accrual method. Accrual methods, income and expenses are recorded as they occur, regardless of whether or not cash has actually changed hands. Example is sales on credit. Sale is entered into the book when the invoice generated rather than when the cash is collected. When an expense occurs, when materials are ordered or when workday has been logged in by employee. Downside of this method, you pay income tax on revenue before you actually receive it. So it is such as disadvantage for the accrual method. So we move to the advantage and disadvantage of accrual method. For the advantage of accrual method is very accurate picture overall of cash, because it can comparing transaction in months, quarter and years, and it will provide a clear picture, because in the accrual method there is no delay payment or expenditure bills. And for the next advantage is reduced income fluctuation. In accrual method, it helps avoid overspending by incurring the expense and not overdraft before the payment. So every purchase must be pay the tax. For the disadvantage is difficulty. The rules regarding revenue and expense recognition are very complicated. Paying tax on income earned but not received is another disadvantage. This is because paying tax on income for while payment has not been received. Like I explained in accrual method, which is the downside of this method is that you pay income tax on revenue before you actually receive it. So the another disadvantage is more tax need to be paid. It need to require to pay tax on revenue booked for current year, and it could result paying bills if there are lot of late paying customer, and this will cause high account receivable. So that's all for me. Thank you.
Assalamualaikum, a very good morning to my lecturer and my beloved friend. So, I am MOHAMMAD and today I want to present about the tax system and some possible tax. Okay, so let's go on. Okay, firstly, what we must have is the tax record requirement. Okay. We must have complete record, includes a list of receipts and expenses for the year, and depreciation schedule and records on real estate and other capitals. Also, we must have complete and accurate record essential for good tax management and proper reporting of taxable income. So from here, we can get the systematic record system, and what the record that we have to always keep. Okay, firstly we have to always keep receipt, bank statement, invoice, payroll records, and any other documentary evidence that support an item or income, deduction, or credit shown on your tax return. And most supporting documents need to be kept at least 3 years, and for the employment tax record must be kept at least 4 years. And to done it more properly, we we are advising to use computerized system that can be helpful to record all this data. Okay, so next is we go to the taxable income. The taxable income, it includes from income as well as income from all other sources minus personal exemption and deduction. The taxable income includes wage, salaries, bonus, and tips, as well as investment income and unearned income. Okay, what is taxable income mean? It is generally described as adjusted gross income, which is your total income, known as gross income, minus any deduction or exemption allowed in that tax year. Okay, the taxable income include wages, like I said earlier, like wages, salaries, bonuses, and tips, as well as investment income and unearned income. Okay, so how do I calculate my taxable income? From your adjusted gross income, it is then calculated by subtracting the adjustment from your total income. Your adjustment gross income is the next step in figuring out your taxable income. When you then subtract deduction from your adjusted gross income, the resulting amount is taxable income on which your taxes are calculated. Okay, this is example for self-employment tax. Okay, from the diagram we can see this for year 2003, which is the income subject to self-employment tax, and the rate is different, where the amount for $0 to $87,000, the rate is 15.3%, and when the money is over $87,000, the rate is become lower, which is 2.9%. So significantly we can see how the different rate for the different amount of money. Okay, so next we go to the possible tax management strategy. There is about 1, 2, 3, 4, 5, 6. Okay, 6 strategy that I listed here. So the first one is form of business organization, income averaging, income leveling, deferring or postponing taxes, net operating loss, and lastly is tax-free exchange. So we go on with the form of business. Okay, form of business, we have partnership. A partnership does not directly pay taxes. It files an information income tax return reporting income and expenses, where each partner's share of income from the partnership is reported on his or her own tax return. Okay. Next, we have sole proprietorship, where the taxes on profit pay at tax rate of owner. And so we go to the corporation. We have two types of corporation, which is first one is C corporation. A C corporation pay taxes on its earning before dividends are distributed. The shareholder then pay taxes on the dividends, as their individual rate, where it means it have double taxation. And so if a shareholder employees their salary and benefit, example like health insurance, can be charged as expenses to the corporation. And but the assumption must be reasonable. So the next one is S corporation. The S corporation is it is more likely like partnership. The corporation file an information tax return, but shareholder report their share of income on their own tax return and are taxed at their own rates. Okay, so we go next to the limited liability company. Okay, the limited company ownership distributed according to fair market value of contributed assets, and the net fair income from an LLC passed to members who pay taxes at their individual rates, which means there are no double taxation. Okay, so next we go. Okay, for the income average. This diagram illustrates how the income average works. Okay, for the first, the left, the left, uh, the left house of the diagram uh, show 100 unit is at 60% AMI, where the rent is $706 to $1,055, and the next picture show the income averaging, where the higher rent unit cross subdivided for the low income unit. So we have three different rates, where 33 unit at 40%, 34 unit at 60%, and 33 unit at 80%. And also the price is different. You can see here 475 to 698 dollar for 40%, $760 to 1,055 at 60%, and 1,050 to 1,595 at 80%. So we can see here it is different percent for different amount, and when the amount of money is increased, the percent also increase. Okay, so now we go to the clean tax. Okay, what is the clean tax? The clean tax liability is a tax that is assessed or is due for the current period but has not yet been paid, and the difference comes from difference in timing between when the tax is accrued and when the tax is paid. And a deferred tax liability records the fact the company will in the future pay more income tax because of transaction that took place during the current period, such as installment sale receivable. For example, a company that earn net income for the year, it will have to pay corporate income tax because of the tax liability applied to the current year. It must also reflect an expense for the same period, but the tax will not actually be paid until the next calendar year. In order to rectify the accrual or cash timing difference, is to record the tax as deferred tax liability. Okay, next is a net operating loss. Net operating loss is a tax credit that occurs when the business tax deductions are more than its taxable income in the year, and this loss is carried forward in future to set off future profit, thus reducing the tax liability of the business. In the initial year, most business don't make any money. So yes, it is normal for a new company that not making any profit in their first year, and it is come well in term of the net operating loss. Okay, so this diagram illustrate how the net operating loss occur. Okay, when the total operating expenses is more than total operating income, and it is calculated by operating income earned minus operating expense incurred, and we get net operating loss.
Okay, let me introduce myself first. My name is Muhammad Hafiz Anwar. So today I'm going to present to you about tax basis. Okay, the tax basis is an asset which is the value for the tax purpose at a point in time. At the time of purchase, it is called a beginning tax basis. As the tax change, it is called an adjusted tax basis. Okay, next slide. Okay, next is a beginning tax basis. Okay, any asset, new or used, they are purchased directly has a beginning tax basis that equal to the purchase price. Okay, let me give an example. Like if you buy an item or asset, they have the value around maybe 3,000 ringgit. So the purchase price is 3,000 ringgit. So the beginning tax basis is also 3,000 ringgit because it equal to purchase price. Okay, when an asset purchase include trade-in, the trade-in asset continue to be depreciated as if it were still owned. So the item still have their own depreciation value. Okay. Okay, next is expensing. In section 179 of the tax regulation, it is provide for expensing, an optional deduction which can be taken only in the year of an asset is purchased. Most is 3 years, 5, 7 and 10 year class property is eligible for this expensing. Okay, section 179 is a tax code that allow a business to deduct full purchase price of the equipment. Like this, let's just say that you buy a van, a car. The price of the van is around 200,000 ringgit. By using expensing, you can deduct the price from the full price, like from 200,000 maybe to 150,000. So you can have more money to do other things. This will encourage the business to buy equipment and invest themselves. Okay, you don't understand it? Let me give you an example. Okay, next is depreciation recapture. Whenever an asset is sold for more than its adjusted basis, the difference is called depreciation recapture. Okay, the adjusted basis we can get by the beginning tax basis minus with depreciation, we get adjusted basis. Okay, if after that the price that the item sold minus with the adjusted basis, the difference it we call depreciation recapture. Okay, depreciation recapture is taxed as ordinary income for the year of sale. Okay. Okay, for those who don't understand it, I have an example here. Okay, if business equipment was purchased for 10,000 ringgit, okay, this 10,000 ringgit is a purchase price and is also called the beginning tax basis. Okay, and had a depreciation expense of 2,000 ringgit per year. Okay, so this is depreciation. So how to find the adjusted basis is like this. After 4 years, they just give me an example, like 4 years, it will be 10,000 ringgit minus with 2,000 times 4. 2,000 depreciation, 4 is 4 years. So after you minus it, you will get 2,000 ringgit. This 2,000 ringgit is what you call an adjusted basis. Okay, if the equipment is sold for 3,000 ringgit, the business will have a taxable gain of 1,000 ringgit because of the price, the sale price is minus with the adjusted basis, which is what you call the present value of the equipment. So you will gain 1,000 ringgit. Okay, the 1,000 ringgit is what you call a depreciation recapture. Okay. Okay, next, try assume the equipment in the example above was sold for 12,000 ringgit. Okay, it means that its sale price is above the beginning tax basis or purchase price. Okay, in that case, the entire accumulated depreciation of 8,000 ringgit, which is the 2,000 times 4, they will treat as an ordinary income for depreciation recapture. So the 8,000 will be the depreciation recapture, not 1,000. Okay. For the additional 2,000 ringgit, they will treat it as a capital gain. Okay, why 2,000 ringgit? Why not 4,000? Is because the 12,000 ringgit, the sale price is minus with 10,000 ringgit, which is the purchase price, the original purchase price. So you will get 2,000 ringgit. Okay, so this example, and next is one of the notes. There will be no depreciation to recapture if loss was realized on the sale. It means that that is the adjusted basis is 2,000 ringgit, but and the business or the company, they sold the equipment for like 1,000 ringgit. So they will have a taxable, no, they will not have taxable gain. They will have a taxable loss of 1,000 ringgit. So it means that they have lost, so there will be no depreciation to recapture. Okay, that's all for me.
So that's all from me. Thank you.
Okay, now we go to MAS, which is a modified accelerate cost recovery system, which is for allows business to recover the cost basis of certain asset that deterioration over the time. And this is annual allowance for the wear and tear, deterioration and obsolescence of the property. Most asset is a tangible asset, which is a building, car, and so on. Okay. Next is the asset and useful life year, which is they already give to you the life useful life for certain asset. For here you can see uh, 3 year, 5 year, 7 year, 10 year, 15 year, 20 year asset, and then you can see the description of asset, which is you can see for 3 year there is for tractor, breeding horse. For 5 year asset, which is a car, computer, and so on. And for 7 year, you can see here this is fence, gas, furniture, and so on. 10 year, 15 year, and 20 year, you can see here. This is that we use this for calculate the mass. Okay. Next is this is a regular mass recovery rate, which is this is not fixed. This is if you this will given by the government for you to calculate this, which is you can see here. This is two table. This is table 1. This is table 2. You can see for 3 year for recovery percentage for 3 year, which is 3 year, which is you can see 33.33%, 44.45%, and this one is 25%, 37.7%, and so on. This is actually not fixed, which is look at the table, of course. And then next is this is how to calculate using the most okay, I give you example, which is the asset is you have a asset which is for a 3 year useful life, which is the cost of assets is 50,000 this year, 50,000, and for year is 3 year useful life. Okay, this is the how to calculate it, which is the book value is the cost, the book value is 50,000 multiply with recovery percentage, which is here you can see 55.55%, and we can change to the point which is 0.25, so you can get 15,000 multiple to 0.25, and you can get this depreciation. And then the end of book value you minus, which is 15,000 you minus to 12,500, and then you get this one, this ending of book value. For the second year, you take the this one, you take the book value at the beginning, or at the first here, which is 50,000. All here is 50,000, and then you multiply with recovery percentage, and then you get this one. And then after you get this one, and you need to minus, which is 37,500 minus depreciation, which is this 80,750, or so on. You need to do is using the table is more easier. And then after, at last, you will get zero ending book value, which is the useful life is, and this is general calculation for March. And then we go to the alternative depreciation method, which is another method to calculate this, which is alternative depreciation method. This is alternative March recovery period, usually longer than regular March, and 150% decline balance, which is alternative decline method, which is use 150% decline balance. And the March that another we calculate this is use 200% declining balance. This is we use formula. The formula is very similar with us, which is we use straight line depreciation, which is cost of asset minus salvage value per useful of the asset, which is very simple, and we always use this. Okay, that's all.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afiq bin Abdul Sattar. Now I would like to continue the presentation, that is capital gains. Capital gain is the profit that is made from the sale of an asset. It is the gain of profit made by selling an asset for more than its original purchase price. Let's say we have a capital gain when we sell the asset. It does not matter how the price has changed since we bought it. Capital gains tax. Capital gains tax is a type of income tax charged on the money earned through the sale of the asset. We have the capital gains tax if we sell an asset for more than we paid for it. So capital gain tax rate for the short term asset owned for a year or less. For example, profit from the sale of short term asset is taxed at the same rate as our regular income. So for the long term asset owned for more than 1 year, example, profit from the sale of most long term asset is taxed at a reduced rate according to our regular income tax. Capital gain and livestock. Cash basis farmer have a basis of 0 on raised, breeding or working livestock. So hence the entire sales value can often be treated as a capital gain. Next, purchase. Livestock may also be eligible, but only if sale price is above original purchase price. Thank you.